Nobody wants to admit it, but America just stepped in to help Japan, and the reason has almost nothing to do with being a good friend. The Japanese yen had fallen to levels not seen since the 1980s, breaking through 160 yen to the dollar and eventually approaching 164. For Japan, this wasn't just a bad exchange rate. A weaker yen makes imported energy, food, and raw materials more expensive, and Japan depends heavily on imports. So Tokyo started fighting back. But then something unusual happened. The United States joined Japan in the currency market and helped push the yen higher. And that raises a much bigger question. If Japan's currency problem is Japan's problem, why did America suddenly decide to help? The answer is hiding inside a financial system that connects Japanese savings, US Treasury bonds, Wall Street technology stocks, and one of the most powerful trades in the world. To understand what just happened, you first need to understand the yen. For decades, Japan had one of the cheapest borrowing costs among major economies. Japanese interest rates stayed extremely low while countries like the United States offered much higher yields. That created a simple incentive for investors. Borrow money in yen at a low interest rate, convert that money into dollars, and invest it somewhere offering a higher return. This became known as the yen carry trade. On the surface, it looks like a simple currency trade. But when millions or even billions of dollars follow the same strategy, it becomes something much bigger. Japanese money starts flowing into foreign assets, including government bonds, corporate debt, stocks, and other investments around the world. And this is where America enters the story. Japan isn't just another country holding a weak currency. Japanese investors are among the world's biggest holders of foreign assets, including US government debt. That means Japan's financial decisions can affect American markets. Imagine Japan suddenly deciding that its currency is collapsing too quickly, and the only way to protect itself is to sell large amounts of its foreign assets and bring money home. That could mean selling US Treasury securities, converting dollars back into yen, and moving capital out of American markets. One country trying to defend its currency could therefore create pressure on another country's bond market. And when the country on the other side is the United States, Washington has a very good reason to pay attention. This is why the yen's collapse became much more than a Japanese story. In June and July 2026, the yen reached levels around 162 and then above 163 per dollar, its weakest level against the dollar since 1986. Japan had already spent enormous amounts trying to support the currency. Between late April and late May alone, Japanese authorities spent about 11.7 trillion yen, roughly $73 billion, on intervention. But the market kept testing them. The problem wasn't simply that traders didn't believe Japan could buy enough yen. The deeper problem was that the economic forces pushing the yen down were still there. The biggest force was the interest rate gap. Japan's policy rate had risen to 1%, but US rates were still substantially higher. That difference matters because investors don't just ask where a currency is today. They ask where they can earn more money tomorrow. If you can borrow yen cheaply and invest in dollar assets with a higher yield, the trade remains attractive. So every time Japan tried to push the yen higher without changing the underlying economics, traders had a reason to sell the yen again. The currency intervention could change the price temporarily, but it couldn't magically erase the interest rate difference. Then came the moment that changed the story. On July 30th, Japan intervened again as the yen approached four-decade lows. And shortly afterward, the United States became directly involved. On July 31st, the US Treasury and Japan coordinated action in the foreign exchange market, with the US selling euros and buying yen. This was extraordinary. America hadn't conducted this kind of intervention for Japan since 2011. And suddenly, the message to the market was completely different. Japan wasn't fighting alone anymore. Washington was telling traders that it was also willing to step in if the yen's decline became too disorderly. The immediate result was dramatic. The yen jumped, with the dollar-yen exchange rate moving down from around 164 toward the mid-150s. But here's where the story gets interesting. If America was simply trying to save Japan, this would be easy to understand. But America doesn't normally spend its financial power protecting another country's currency for free. There had to be something at stake for the United States itself. And there is. In fact, there are several things at stake. The first is US Treasury markets. Japan has enormous holdings of US government debt. If Japanese authorities became desperate enough to defend the yen by dumping large quantities of dollar assets, that could put upward pressure on Treasury yields. Higher Treasury yields mean higher borrowing costs for the US government. They also influence mortgages, corporate borrowing, stock valuations, and basically the cost of money across the American economy. At a time when global governments are already borrowing heavily and long-term bond yields are rising, Washington has very little interest in creating another source of pressure. And there's a second problem that is even more subtle. Japan's cheap money has helped create a global financial ecosystem. For years, investors could borrow yen cheaply and invest in assets that paid more. That money didn't stay in Japan. It moved around the world. Some of it ended up in US treasuries. Some went into corporate bonds. Some went into equities. Some went into technology and growth stocks. So when the yen suddenly strengthens, the trade can work in reverse. Investors who borrowed yen may have to sell the assets they bought and convert their money back into yen. If enough investors do this at the same time, markets can fall very quickly. This is why a stronger yen can actually create a strange problem for Wall Street. Normally, you would think a stronger currency is good news for the country behind it. And for Japan, a stronger yen can absolutely reduce the cost of imported goods and energy. But if the yen strengthens too quickly, the global carry trade can begin to unwind. And that can force investors to close positions across other markets. In other words, the real fear isn't simply Japan losing money. The fear is a chain reaction. Think of the global financial system like a giant stack of blocks. Japan is one block. The United States is another. European markets are another. Emerging markets are another. They look separate, but huge amounts of money connect them. If the yen suddenly moves violently, the shock doesn't necessarily stop in Tokyo. It can travel through bond markets, currencies, hedge funds, banks, and stock markets. That's why American officials have been paying such close attention to the yen. U.S. Treasury Secretary Scott Bessent has argued that an orderly and more stable yen matters beyond Japan itself, but there is another reason America may want Japan to stabilize the yen: inflation. A weak yen makes imported goods more expensive for Japanese consumers. That is particularly painful when energy prices are already elevated. Japan imports large quantities of energy, much of it priced in dollars. So when the yen falls, Japan effectively has to spend more yen to buy the same amount of energy. That feeds into transportation, electricity, manufacturing, food, and household expenses. The weaker currency can therefore create an inflation problem that becomes harder for the Bank of Japan to control. And this creates a trap. Japan needs higher interest rates to make the yen more attractive. But higher interest rates make borrowing more expensive. Japan already carries one of the world's largest government debt burdens relative to its economy. If Japanese bond yields rise significantly, the government's interest bill can become much more painful. And if markets start demanding even higher yields to hold Japanese government debt, the problem can reinforce itself. Japan therefore has to balance three things at once: protect the yen, control inflation, and keep its enormous debt burden manageable. That is why intervention alone isn't enough. Japan can buy yen with its reserves, but it can't permanently fight the entire global foreign exchange market if investors believe the underlying economics are pointing in the opposite direction. The market knows this. That's why the yen initially strengthened after intervention and then came under pressure again. By mid-August, the currency was again hovering near the 160 level despite the earlier intervention. Reuters reported that the yen had gained about 5% after the intervention effort but struggled to maintain those gains. So what does Japan actually need? The most obvious answer is a different interest rate path. If Japanese rates rise while US rates eventually fall, the gap becomes smaller. That reduces the incentive to borrow yen and buy dollars. Can also encourage Japanese capital to stay at home. But there is a catch. Japan can't simply raise rates aggressively without consequences. Higher rates can hurt borrowers, weaken parts of the economy, increase government financing costs, and put pressure on the country's already massive debt burden. And this is where the 1986 comparison becomes fascinating. The chart you often see showing the yen at a similar level to 1986 isn't just a random historical coincidence. In the mid-1980s, currency markets were being heavily influenced by international policy coordination. The Plaza Accord of 1985 famously brought major economies together to push the dollar lower, after which the yen appreciated sharply. Today, the direction of the currency movement is different, but the underlying lesson is similar. When major economies coordinate their currency policies, they're not just moving exchange rates. They're trying to manage the consequences of huge global capital flows. The difference today is that the global financial system is much larger. The amount of money moving through government bonds, derivatives, ETFs, hedge funds, and multinational corporations is enormous. A currency that moves several percent in a few hours can force institutions to rebalance positions worth billions of dollars. That's why policymakers are terrified of disorderly moves. A normal currency adjustment is one thing. A sudden, self-reinforcing collapse is something else entirely. And now we can understand the real reason America stepped in. It wasn't simply to rescue Japan. It was partly about protecting the plumbing of the global financial system. America has an interest in preventing Japan from being forced into a disorderly liquidation of foreign assets. It has an interest in keeping treasury markets functioning smoothly. It has an interest in preventing a violent unwind of the yen carry trade. And it has an interest in making sure a currency crisis doesn't become another global financial shock. There was even another mechanism being discussed that makes this relationship more interesting. Japan can potentially use the Federal Reserve's FEMA repo facility to borrow dollars against its U.S. Treasury securities instead of selling those securities outright in simple terms. That can give Japan access to dollar liquidity without forcing it to dump huge amounts of treasuries into the market. That's important because selling treasuries aggressively could create exactly the kind of market pressure Washington wants to avoid. And this is the part nobody wants to say too loudly. America may need Japan almost as much as Japan needs America. Japan is a major financial partner, a major holder of U.S. assets, and an important part of the global capital system. If Japan's currency collapses in an uncontrolled way, the consequences don't remain inside Japan. They can reach American bonds, American stocks, American borrowing costs, and even the technology sector. The financial world is interconnected in ways that aren't obvious when you're looking at one country's exchange rate. But there is still a huge problem. Intervention can buy time, but it cannot manufacture confidence. If investors continue to believe that Japanese interest rates are too low, Japanese fiscal policy is too loose, and the country's inflation problem is getting worse, they will keep looking for opportunities to sell the yen. That's why markets are now watching the Bank of Japan much more closely. Recent expectations for an earlier rate hike have increased sharply, because traders understand that a lasting solution probably requires more than foreign exchange intervention, and that brings us to the biggest question. What happens if the yen falls again? Because the United States has already shown the market that it is willing to intervene. Once policymakers cross that line, traders start asking where the new line is. Will Washington intervene again at 160, 165, 170? Or will it eventually decide that the market has to find its own price? Nobody knows. But every intervention changes the expectations of investors, and expectations themselves can move markets. There is also a dangerous possibility on the other side. What if Japan raises rates aggressively to defend the yen? That could strengthen the currency, but it could also make the yen carry trade much less attractive. Investors who have spent years borrowing cheap yen and buying higher-yielding assets may suddenly decide to unwind those positions. If the unwind happens too quickly, assets around the world could feel the impact. So policymakers are stuck between two risks: allow the yen to weaken and inflation gets worse, or strengthen the yen too aggressively and risk destabilizing the global carry trade. That is why the phrase "America bailed out Japan" is both true and misleading. America did not write Japan a giant check. It didn't erase Japan's debt. It didn't fix Japan's economic problems. What it did was much more subtle. It stepped into the currency market and helped Japan buy time. And sometimes, in global finance, buying time is the most valuable thing a government can do. Because the real crisis isn't the number 160. It isn't even the number 164. The real crisis is what happens if investors stop believing that the system can absorb the pressure. Japan's currency, Japan's bond market, U.S. treasuries, the carry trade, and global risk assets are all connected. When one part starts moving violently, everyone else starts watching. So the next time you see a headline saying the yen has fallen again, don't just look at the exchange rate. Ask a different question. Who's on the other side of that trade? Who owns the dollars? Who owns the bonds? Who borrowed the yen? And what happens if all of them try to reverse the trade at the same time? Because that's the real story behind America's decision to step in. It wasn't just about saving Japan. It was about preventing one of the world's biggest financial dominoes from falling too hard and taking everyone else down with it. And history has a habit of reminding us that the biggest financial crises rarely begin with one dramatic event. They begin when a system that looked stable becomes dependent on everyone continuing to believe that it will remain stable. The yen is now testing that belief. Japan is fighting to stabilize its currency. America is trying to prevent the shock from spreading. And investors around the world are watching one number very closely: the price of $1 in yen. Because if that number starts moving violently again, the next bailout may not be about Japan at all. It may be about the global financial system itself.